The US stock market just had one of its best 15-year returns in history. In today's video, we are going to be talking about why that's good news and why that may be potentially bad news for some investors. So give us a little context. Let's look at this chart. So going back to 1970, we've got this purple line. And this purple line has been the rate of return for the US stock market from 2010 to 2024. And so we say, okay, is that good or bad? Well, let's compare that to every other 15-year return going back to 1970. You see all these grayish black lines show up, and they are below or end up below this purple line. And so over every 15-year run since 1970, the one we just had has been the best performance. So why is that good news? Well, clearly, if you were a U.S. stock market investor and that was your primary investment strategy, you have done very well. You just had the best run in 15 years. Your portfolio has gone up dramatically. So why might this be bad news? Well, this might be bad news is if your primary investments are the ones that have just done really well and you have made no adjustments or plan on making no adjustments. Because the way the markets work, when you think about averages, if you just had your best 15 years ever, and we know the markets usually come back to their averages, doesn't necessarily guarantee the worst 15 years to get to average, but what it does mean is you may have a period of underperformance where you don't do as well as you've been doing because it's not the way the market works. When you look at dividends, when you look at earnings over the last 15 years, yes, they've gone up. But one of the reasons that U.S. markets have gone up so much over the last 15 years is not just those dividends and earnings or the fundamentals of the company, but it's the multiples. So the price that people are willing to pay for those same fundamentals has gone up dramatically. So people have started paying, or another way of saying this is overpaying for those dividends and earnings. And if things just come back to normal and come to normal valuations, it could spell not great news for the U.S. markets. And I've spent many videos talking about this, about the expected rate of return, in particular technology companies, S&P 500, where these can be great companies. But if they get too expensive, it just means the stock price may not do what it's done in the past, and you should be aware. And so the great news is owning them has been profitable. The bad news is if you expect this to continue and your portfolio has not adjusted, you may be in for a big surprise. And so what should you do? Take a look at your portfolio and look at the expected rates of return. And we've talked about this in many videos. While the future is unknown, we do have good numbers on the price of assets today, and where we can make conscious decisions and say, okay, looking back is great, that gives us context, but now we need to look forward. The things that have gone up in value have gotten more expensive. Are they still worth it? Are the assets that we owned prior, do they still make sense to own today looking forward? And as I always say, know what you own and know why you own it. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.